Okay, good morning, everybody, and welcome to the Daily Energy Markets Forum, where we take stock of the open in Asia. And today, June 17th, Thursday, let's kick off with our regular Thursday morning commentator, Dr. Carol Knackley, CEO of Crystal Energy. The morning after the night before, Carol, the Fed has spoken. They have finally started to thinking about meeting or some acknowledgement thereof that they might have an actual responsibility. Your thoughts on the Fed meeting yesterday and its ramifications for everything?
Good morning, Sean. Indeed, I was getting my head around the expression of the chairman of the Federal Reserve, where he said, talking about the meeting, and I couldn't figure out what that meant, but actually got me worried, because we finally got the Fed telling us that, okay, we're going to taper our policies and then going to consider increasing interest rate at least once by 2023. And that is already a sign that they are concerned taking inflation more seriously than before. Because remember, for the last several meetings, they kept on telling us that no, inflation is not a worry. It's a question of rebound, not recovery. And whatever we have now is temporary. And we're not going, it's too early and premature to raise interest rate. Now, though the chairman keeps on saying it's still premature to talk about raising interest rate, but they're already talking about an earlier date, which is 2023. And why I'm saying I'm concerned about this, because who knows what they will say at their next meeting. Maybe they're going to bring that date even closer to where we are today. So this highlights that the Fed, which was dismissing the inflation fear, is now taking it more seriously than before. And as a result, we saw yesterday some market reaction, though maybe a bit too early to see a major reaction in terms of volatility, but people are concerned about this tightening of the monetary policy that we've seen because of COVID-19. So this is the main takeaway I take from the meeting yesterday. They didn't take any action immediately, which was predicted actually, but the fact that they are bringing the date forward in terms of increasing interest rates at least once, and people are talking about twice increasing interest rate by 2023, is an area for me that I would watch closely at their next meetings.
Matt Stanley, director at Star Fuels here in Dubai. Matt, when I was watching the Fed press conference yesterday, I couldn't help but thinking about the Monty Python sketch, the Dead Parrot. But I couldn't quite figure out which character in the Dead Parrot sketch. There's the shopkeeper, there's the Dead Parrot, and there's the John Cleese customer. And which one of them is the Fed? Which one of them is inflation? It's sort of, they could be any one of the three in a way. But your thoughts on the outcome of the Fed meeting yesterday?
You know, when you're at your uncle's 60th birthday party and you're the last one dancing in the disco and someone puts the lights on and you suddenly realize that the party's over and you're gonna have to wake up in the morning regretting what's happened. That's kind of, I feel like the first flicker of lights was switched on that party yesterday, and that stimulus party. That's what the market is concerned about. I thought we would see more of a reaction on cable. You know, it dropped below 140, you know, sterling dollar. That's back around that level. We've been flirting around that 140 handle for a while. Crude, it didn't really, you know, nothing seems to affect crude at the moment. You know, we were down 75 cents earlier on you know, on the back of this sort of hawkish attitude that the Fed seem to have at the moment. But yeah, largely it's being ignored. I think that people will watch ever closer the inflation figures that are coming out. You know, April inflation numbers were the highest since 2008 in the US. May was acceptable apparently, but I think people will be really keeping their eye on inflation monthly levels, especially when crude and products are up at 2018 highs. So we'll have to wait and see.
Randall Mohammed, former VP Energy Solutions at AHAR Solutions International, sitting in the United States. Randall, your thoughts coming out of the Fed? Of course, the inflation numbers that we're seeing are very much in the US, 5%. I mean, the American economy is the one that is apparently overheating, but it seems to be somewhat confusing still to me that you can have an overheating economy and yet you've got zero interest rates and you're purchasing $120 billion a month. Because I describe that as being on life support. These two things I continue to find confusing.
Yeah, good morning, Sean. Good morning, everyone. Sean, look, you're absolutely correct. And I was quite confused myself and was wondering, actually, when would the Fed take action? So frankly, I'm not surprised that the Fed made a decision to taper back asset buying. You mentioned $120 billion of Treasury bonds, which the Fed trades with its dealer banks on a daily basis. Or monthly, on a monthly basis.
That's
yes,
the amount monthly, yeah.
Sorry, monthly, yes. Through what we call open market operations. Yeah, it's what we call repos and reverse repos, where the Fed is able to buy and sell these Treasury bonds in an effort to either loosen or tighten the money supply and credit. So look, yes, inflation is there. The economy is heating up as we transition out of the pandemic, but the Fed continues to describe it as transitory. That's debatable. A lot of analysts are debating that term that the Fed is using, but I think it's a relatively good term. And the Fed used the increase in timber prices as an example. So timber prices have gone up by 175%, but have since come down by about 40%. So it's in that context they're using this term transitory. Now,
but the result of that is that's the sort of new housing starts in the United States, even though the demand is significant, because the supply chain is so constrained, you can't build the houses that there is demand for. So the economic activity doesn't take place.
Absolutely. And you're correct, Sean. And that is one of, what we call sort of leading indicator. One of the indicators that the Fed uses, there's a leading, lagging indicators. But, with regard to interest rates, I just want to point out that, the Fed fund, what we call the Fed fund rate, is at a historical low, 0.06%. Then you've got the discount rate, which is the rate by which the banks borrow from the Fed. That's at 0.25%. So really, it is really at historical lows, these rates. And I think, Sean, what goes down must eventually go up.
On this point, I mean, we've talked a lot over the last year, at least much of last year, that the recovery was really a sort of a Wall Street, not a Main Street. I mean, when you look at these sort of decisions, these monetary fiscal decisions, it would tell you from this distance, people must be starving in America. Like, how bad is the economy in America that you basically need free money every day and food stamps and, the Fed printing 120 billion. I mean, is it really that bad on Main Street?
Well, Sean, look, there is going to be a segment of the population, that will go through that sort of suffering period. Yes, look, there are many, many businesses, Sean, that have closed. It may not hit the media, but, I could just look around in my community only and see hundreds of businesses, small businesses that have shut their doors, and it's highly unlikely they're going to reopen. So look, these people need help, and they did get the help. The Fed did come to the rescue, but I think that's the end, Sean. I don't think we're going to see any more stimulus again. So look, it's just a matter of bringing the economy back up. We need to get back to normalcy. And we said it from the beginning, Sean, that the vaccines has been the end game.
Carol, the talk about talking is, of course, not funny in some regards. Inevitably, when you look at the impact on the dollar, for example, and then the follow through of the impact on Asian markets, emerging economies whose currencies are very exposed to the dollar. How do you see the sort of fallout, if you like, for the more weaker global members of the economy?
First of all, for the dollar's reaction, that is expected, because when you think of interest rate, this is the price of money. Of course, for the lenders, it's the cost of money, but those who hold the currency, it's a reward for them. So that would be a natural reaction. Of course, there is a long chain of reaction, including on the oil export, especially those that have their currency pegged to the dollar. So their impact is not just on the poorer nations, but it also includes some actors we don't often think about. But actually what Mohammed was saying that about the fiscal stimulus, it made me think how the fluid the situation still is today. I mean, remember 2 weeks ago, I went on the show and I said how I looked at the markets and everything looked green. Now I look at the markets, everything looked red. This tells you how much also the market, the health of the economy is still dependent on what governments, what central banks do. Now, of course, this doesn't change the overall path on which the economy is. So we are going through the recovery, but there are bumps on the way. But the quick question remains is that when governments are going to withdraw their support for the economy, their massive support, when central banks are going to also tighten their policies, can the economy go back to the same growth rate that we saw before the pandemic? So we talk about going back to normal. I know one of your articles that you put today was about the return to the office. That is one small aspect that makes us think about the bigger macro picture. When we talk about going back to normality, it's not about going outside without a mask. For me, it's a much bigger question about the growth rate that you were experiencing all around the world in terms of the GDP growth rate. Are we going to go back to that path and continue the growth, or are we going to grow but at a much lower speed? That is a big question. I guess only time will answer it.
Matt, we're touched nearly $75 a barrel yesterday. 74.96 was the high intraday trade. This market is trading on fundamentals as well. Ultimately, we saw a massive inventory draw, over 7 million barrels confirmed, first by the API, then by the EIA. The fundamentals are quite solid. The OPEC still holding very tight reins.
Yeah, look, I mean, excuse me. Yes, crude is drawing. Stocks have been on a downward trajectory for a while, but gasoline inventories are the highest since February. And if you want a bellwether for demand, lots of people will look at what's called the 3-2-1 crack in the US. That's 3 barrels of WTI in, 2 gasoline out and 1 diesel out. That's the lowest it's been since February as well. That was trading $25 a barrel in May. It's now trading just above 17. So yes, crude might be going places, but this same argument, crude has to be burnt and then refined and consumed in order for oil demand to look anything like the tangible. These forecasters, the second half rhetoric is all about demand is going to come roaring back. You look at real tangible data regarding demand, and I can't form that same argument for the second half rhetoric. His Highness Sheikh Maktoum, the chairman of Emirates Group, on Tuesday, who's historically, he's run a fantastic business for the last 30 years. Emirates Group reported a $6 billion loss. Wasn't surprising, most airlines have. But his outlook was not bullish. That hub and spoke model that Emirates have is still in a perilous state. And of course, people are hoping that air travel is going to come back. I was talking to a friend last night. If you look at Asia and what's happening in Asia, China, Singapore, the Antipodes have got no interest in opening borders anytime soon. They're pursuing this zero case agenda. That's completely up to them. But 5 million barrels of oil demand is still lacking from pre-pandemic. Half of that demand that's forecast to come back is jet fuel, right? So I think he told me that jet fuel demand into the EU is about 700,000 barrels a day. This year so far, it's been about between 150 and 200. So I look at these data, Sean, and yes, I see crude going places, and I don't see the products that's being refined going anywhere close to what these forecasters are assuming it's going.
Rustin pointed out yesterday that tanker rates are still way down, and that the freight markets are not buying into yet that there is a big wave of oil coming.
You know, he's got a point, and of course he's the one feeling the pinch because he works for one of the world's biggest shipping companies. So he's right. This is the irony. You've got more cargoes coming back with OPEC bringing back production, and you've got a backwardated market which would out till, well, on crude, I think it's $3.60 out until December. So if you put oil on a ship and store it, as Vitol are doing off the coast of Southwold in the UK at the moment, you know, it doesn't make sense because the market is such strong backwardation that you just can't cover that cost. So it doesn't ring true to me that freight being so weak because there's not as much demand for arbitrage cargoes, but flat prices where it was before the pandemic was even hinted at.
Randall, you made the comment earlier that you don't see more stimulus. We have Joe Biden returning to the United States this morning after a week in Europe with all sorts of different meetings, most notably yesterday with the Russian president, Vladimir Putin. How do you think he comes back to the US? Is there wind in his sails that gives him more muscle to get this infrastructure bill through?
Yeah, look, that's a good question, Sean, but I think definitely you got to give him kudos for the way he handled the vaccine rollout. I think he did a very good job, and I think he sort of met his objectives. You know, I mean, I can talk for Florida. You know, we are more than 50% vaccinated, and I think he's well on stream for that July 4th target. And Sean, if you look at the news, you're going to see a lot of cruise ship bookings. You know, cruise ship bookings have increased. You know, these vessels are ready to sail. The one contentious issue, especially out of Florida with our governor, is that he's saying that the cruise ships have no right to demand vaccination or proof of vaccination from their guests. Now that's only Florida. Other U.S. ports, it is required. You know, you are required to show proof of vaccination at other U.S. ports, except for Florida. So, but look, you know, I think that augurs well for demand, that the cruise ship industry is about to sail. So, you know, we need to look out for that as well. But I think Mr. Biden, you know, I think there is some good plus points for him. You know, with regard
to appetite for that sort of infrastructure, $2 trillion big spending bill, even though it's spread out over a number of years, will that be muscled through, do you think, in the coming weeks?
Well, I think it's going to be a challenge. It's not going to be a walkover for Mr. Biden. Yes, he's got the House and he's got a slim lead in the Senate, but it's not going to be a walkover. I think the Republicans are going to try to push that figure down. But look, you know, we just have to wait and see. It's debatable. I can't say if it's going to go through or not. Right. Okay.
Carol, we also had yesterday Prince Abdulaziz bin Salman, the Saudi energy minister, speaking at a conference in Wall Street. Actually, it was a virtual conference, but nonetheless with a very exclusive hedge fund crowd of Wall Street, where he warned them that a lack of new investment into oil exploration could trigger this much talked about commodity super cycle.
Yeah, this is the same old story, right? When prices are tightening, we worry about the investment gap, that investment today is much lower, for example, than it was a few years ago. And as a result, you would end up having tighter supplies in the future. So that is, of course, a legitimate concern. And but the problem is that I'm yet to see that happening. We saw that perhaps in the early years of the century, but since it hasn't quite materialized, despite the warnings. If you remember a few years ago, both the IEA and OPEC were singing the same song, warning of that. And today people are making the same, expressing the same concerns. But why I have, some question marks around this issue of investment gap, for several reasons. One of them, why would it matter if demand doesn't rebound so strongly? So investment gap would matter if they really have a strong demand growth and you have supply not able to catch up, and you have usually low OPEX spare capacity. So if you look at this kind of trend in the past where you had a tight market, fears of investment gap, you had these conditions coming together. Today, demand is growing, but is it really at massive growth rate? I'm not quite sure. I mean, Matt expressed his concerns. Yes, we're expecting return to pre-COVID level next year, but there are, again, uncertainties around the speed at which demand will continue to grow. You have spare capacity of OPEC is quite high. It's almost 9% of world oil production, if I'm not mistaken, or slightly less than that. So there is a cushion, a safety cushion. Now, of course, it all depends on OPEC's policy vis-a-vis not just its production release of barrels, but also what it will do with the spare capacity. The more they sit on the spare capacity, the higher the chances that prices will go up, and the higher the chance that people are going to start investing more. So it's never about one thing. And that's why I think the investment gap, the fear of investment gap, has not really materialized so far. Maybe I'm wrong, but it all depends on many moving parts.
Before we bring in the survey question, I just wanted to bring to everybody's attention that we are currently in the process of administering the Aramco Trading New Silk Road CEO of the Year Awards. And as regular attendees of this webinar and as commentators, you will all be invited to vote on this awards. We've gone through a series of processes in these 5 categories with the International Selection Committee, who have narrowed it down to a top 5 list. And so you'll all receive an email over today, I believe, to vote on this 5 different categories. So we'd welcome and invite you to do so at your convenience. Let's bring up the survey question. And again, it's sort of on the theme today. What impact will the Fed's process to start thinking about tapering, easing have on the oil markets? Is this overall a bullish or bearish process for oil markets? We're sort of come through the period in which, no, we're not doing anything, everything's perfect. And now we start the process of, as Matt so elegantly put it, the lights have been turned on in the wedding that went on far too late, and the king has no clothes, perhaps. But is that process going to be bullish, supportive to oil prices, or will it be bearish? Welcome your views on that, and we will take it forward. Matt, it is the end of the week here in the Middle East, but not the end of the week in the trading world. How do you see the rest of this week playing out? Do you think we could tip over that big 75 handle, or are we retreating?
I just want to touch on what Dr. Carroll said, which I thought she raised an excellent point. It's the same old argument that we're having. I would like to have been in that virtual conference when Prince Abdulaziz, didn't he tell them not to drill, baby, drill? Didn't he tell them that to stop all their antics? And now what's he saying? Now he's saying, please get involved in the shale patch and start pumping oil. I mean, I find it quite ironic that, as Carol said, they're sitting on all this idle production, but they're encouraging others to invest in the oil producing sector as well. And the market has relied on what OPEC have done. The rally has been triggered from supply curtailment. The demand rhetoric, as again I mentioned, and Carol said as well, Q4 22 is when Trafi and Vitol see it coming back. I agree with that. But it's Igor Sechin as well. He's a notorious bullish commentator and bullish guy. Vitol just bought, I think, 5% of the Vostok Western Siberia production. And he made a great point. Igor Sechin said, the world consumes oil, but no one wants to invest in it. And I think that's the reason. And that's the reason behind it. The dreaded triple figure word, the $100 oil, is very much a possibility. Because if the world relies on OPEC to keep prices elevated, it won't rely on them to keep them suppressed. You know, do they say we are going to keep a cap on prices at a maximum of $80 a barrel, but we're not going to allow them to go below 60? All you're going to do is, based on what Mr. Sechin said, I think the break even on that Western Siberian field is $35 to $40 a barrel. Shale producers say it's $60 a barrel. It's TI 71, 75 right now. I think what's going to happen is, and Marco Dinant had hinted at this, COVID has accelerated the renewable argument. You've got a big drive on that yourself, Sean, Gulf Intelligence, the hydrogen discussion. They're all discussions that we need to have. And the hedges have been brought forward that the world won't rely on fossil fuels maybe in 30 years. There will be a renewable agenda, of course. But in the meantime, we all still need to drive our cars because we all haven't got Teslas, and we all need to fill them up somehow. And I think that you will see most of those traders get into the shale patch because the likes of parsley or cilantro or oregano, whatever they're called, they're not getting into those fields. I think that it's going to be left to the big traders because they've come out with some pretty punchy comments in the last few days. And that's what I'm keeping my eye on. I think it's overall trader sentiment, because the fossil fuel argument is now no longer something that the Shells and BPs and Totals aren't really discussing.
Randall, your thoughts on that? I mean, ultimately, we had on the halftime talk this week commentating that all of the U.S. majors are in the West Permian Basin. They are definitely planning their future of harvesting that lucrative resource, but slowly but surely returning to that. Your thoughts on the outlook of how that plays in the second half of the year?
Yeah. Even with WTI prices up in the 70s, definitely it's going to be slow. That rate of recovery is going to be slow. As we mentioned previously on this program, Sean, the capital simply isn't there. And producers are now focused on cost discipline. They're more focused on returning capital to their shareholders. So it's really not about drill, baby, drill. This really is about cost discipline, returning capital to shareholders. You've also got the pressure on the likes of the oil majors with regard to net zero carbon. You see what's happening with Shell. You see what's happening with BP. So you've got that added pressure as well. Yeah. So my forecast is definitely that it's going to be a very slow shale recovery. It could be over a process of 3 to 4 years. But getting back to that 13 million barrels per day, it's difficult, Sean. I'm just not seeing it at this point in time.
Well, $100 oil, even $75 oil, you think would be incentive enough. Let's get the survey question result and give Carol the last word. Fed's process to start thinking about tapering is going to be bullish, supportive for the markets. Carol, you started out your comments this morning saying that perhaps it might be a little too early to tell what the fallout from the Fed's posture yesterday is. How do you see that unfolding as it gets absorbed in the coming days and weeks?
Yeah, the coming days will be, again, it's too short notice, but there are some announcements coming out of other major economies, if I'm not mistaken, Japan, for instance. Who just
announced that they're going to be reopening and having the Olympics and so forth.
Yeah, so, and also their monetary policy, their central banks policies as well in other countries. So it's an unfolding story, but we should start to get accustomed to the fact that more and more governments and their central banks are going to start to taper their supportive policies that they implemented to revive the economy after it was hit by the tsunami of COVID-19. And this is quite right. The time is right and ripe because the vaccination rollout is out there. But again, they have to be careful with the speed at which they want to do that, because you don't want to create massive volatility in markets, and therefore whatever policies you're going to pursue is going to backfire on and reverse the gains that you have achieved so far. So it's a quite delicate act of balancing between withdrawing the support to the economy and letting the economy stand by itself, because it is going in the right direction. For the Fed, we'll watch more closely what they are going to say and announce in coming meetings. At this stage, we heard that, okay, nothing is going to happen, but they are already thinking about it. Who knows whether they're going to bring that date forward? And this is something that I think not only me, but the market observers are going to watch very closely. And we might see more and more volatility in the stock market if we remain in this kind of bringing that date forward and forward.
Well, in some ways, it becomes nearly a self-fulfilling prophecy, because the more the market and corporates believe that, the less investment will go into new capacity. I mean, they'll talk about shale in the Permian, but whether you're manufacturing cars or manufacturing anything, what's your incentive to invest in another assembly line if you know that in a year or two the party will be over? And so as a result, supply constrained, prices go higher faster, and rates will have to come sooner. Back to where I started on my analogy of the dead parrot sketch, I request everybody to go on to somewhere on my Twitter or LinkedIn and give me your own prognosis. My view is that the Fed is the shopkeeper and the parrot is deflation. And the shopkeeper keeps saying, no, the parrot is not dead. He's just sleeping. He's resting. And John Cleese keeps saying, this parrot is dead. No, deflation is there. We have to all be worried about deflation. So we're going to let inflation run to the sky because the parrot is not dead. That's my analysis of that little analogy. Anyway, it's always worth 5 minutes to look at that sketch. It's the funniest thing in TV history. Thanks very much, Randall, Dr. Carroll, and Matt, for your time. End of the week. Have a great weekend, everybody. We'll catch up with you on Sunday. All the best. Cheers.